The financial advisor who manages your retirement savings is legally allowed to make more money when your returns are lower, and most of them do. Hey everyone, I'm Prahlad Kumar, an MBA and PhD in economics. I've spent years studying how small behavioral shifts quietly shape massive wealth gaps. And here's the truth most people miss. It's not big, dramatic decisions that change your financial future. It's tiny, consistent habits that compound over time. Behavioral economics has proven this again and again. Systems beat motivation every single time. So today, I'm going to show you the exact framework. Before we go further, I need to tell you 3 things. First, I'm going to show you exactly how mutual fund fees are deducted, not from any statement you ever see, but silently every single day, before your returns are even calculated. I'll show you the precise lifetime dollar cost of that invisibility. Second, I'm going to name a single administrative switch available to millions of investors right now, requiring no new money, no new account, and no advisor. That adds the equivalent of a decade of returns to a retirement portfolio. Most investors have never been told it exists. Third, I'm going to give you the performance data that the fund management industry spends millions every year to keep out of mainstream conversation, and I'm going to show you why the number is not just high, but mathematically inevitable. Let me tell you about David. David does everything right. He saves every month. He hires a credentialed advisor. He invests in professionally managed funds. He checks his balance once a year and it grows. David feels good about his financial future. What David never sees is the number his portfolio was before the fees came out. Vanguard ran the calculation in 2022. A 1% annual fee difference on a $100,000 portfolio over 30 years costs the investor $243,000 in lost compounding. That is more than the original investment. David did not lose that money in a crash. He did not lose it to fraud. He handed it over voluntarily, and he signed the paperwork to do it. Now move that story to the United Kingdom. The average UK retail investor in an actively managed fund pays a combined annual cost of 1.65%, fund charges, platform fee, and advisor charge combined. The FCA published this in their Consumer Investment Data Report in 2023. The average UK passive index equivalent costs 0.22%. On £50,000 invested over 25 years, that gap costs the investor £87,000 in lost compounding. That is not a rounding error. That is a deposit on a second property, silently extracted year by year from a portfolio that appeared to be growing. Take that same story to India. The average Indian equity mutual fund charges 1.8% annually in total expenses. But underneath that sits a structural conflict that makes the UK problem look transparent. In India, a mutual fund distributor earns a trail commission of up to 1% every year for directing your money into a regular plan fund. A direct plan of the identical fund, same portfolio, same manager, same stocks, charges 0.8 to 1.2% less per year. The distributor earns nothing from the direct plan, so the distributor never mentions it. Fewer than 15% of Indian retail mutual fund investors are in direct plans. The rest are in a fee structure that was designed entirely for someone else's benefit. Move that story to Nigeria. Every formal sector worker in Nigeria enrolled in the contributory pension scheme pays fees to a licensed pension fund administrator, fees that are deducted before their balance is ever reported to them. Effective all-in costs run between 1.4 and 1.8% per year. PenCom published this in their 2023 annual report. Over a 30-year contribution horizon, those fees consume an estimated 22 to 28% of terminal pension wealth. 1/4 of a lifetime of retirement saving, gone. Not to a market crash. Not to inflation. To fees that never appeared on a single statement. The most dangerous financial product in the world does not look dangerous. It comes with a prospectus, a credentialed manager, and a professional handshake. And it is quietly, mathematically certain to make you significantly poorer than you should be. Now I want to show you exactly how the mechanism works, because once you see it, you cannot unsee it. Every mutual fund calculates its net asset value daily. The NAV is the number you see when you log into your account. It is the price per unit of your fund. Here is what the industry does not explain in any marketing material. The management fee is deducted from the fund's gross asset value before the NAV is calculated. You never see the gross number. You never see the deduction. You only ever see the net figure, the number after the fee has already been removed. The fee does not appear as a line item. It does not appear as a deduction on your statement. The money disappears from your compounding base silently, automatically, and invisibly, every single day. This is not an accounting accident. This is the deliberate structural design of how fund fees are collected globally. Now let me show you what the performance data actually says, because this is where the industry's entire argument collapses. S&P Dow Jones Indices runs the SPIVA scorecard every year. It is the global standard for measuring active fund performance against passive benchmarks. Over 15 years in the United States, 92.2% of actively managed large-cap fund managers underperformed the S&P 500 index. That is not a bad year. That is 15 years of data. In India, 85% of active large-cap funds underperformed the Nifty 100 over 10 years. S&P SPIVA India Scorecard 2023. In Brazil, the market where the industry most aggressively argues that active management adds value, 97% of active funds underperformed the Bovespa index over 10 years. S&P SPIVA Latin America Scorecard 2023. The highest active fund failure rate of any major tracked market, in the exact market where the industry promised it would work best. This is not a coincidence of bad managers. This is arithmetic. In aggregate, active managers collectively hold the market. Before fees, their average return must equal the market, because they are the market. After fees, their average return is the market minus fees. Underperformance is not the risk of active management. It is the guaranteed mathematical consequence. John Bogle proved this in 1975. The industry has spent 50 years funding research designed to make you doubt it. Now I want to name the psychological mechanism that keeps investors paying these fees even after they encounter this data. The bias is called the IKEA effect. Researchers Michael Norton, Daniel Mauchon, and Dan Ariely at Harvard Business School identified it in 2012. They found that people assign dramatically higher value to things they have partially built or chosen themselves, even when the outcome is objectively inferior to an alternative they did not select. In the original experiment, participants valued self-assembled IKEA furniture at nearly the same price as professionally built furniture, despite obvious quality differences. Apply this to fund investing. When you select a specific actively managed fund, you read the literature, you evaluate the manager's record, you make a deliberate decision. You have cognitively built your portfolio. The fund becomes yours in a way that a passive index fund, chosen automatically, never feels. This psychological ownership makes switching feel like self-betrayal. The average holding period for an underperforming actively managed fund chosen by a retail investor is 6.3 years. That is 6.3 years of paying for documented underperformance, because the brain refuses to abandon what it built. The industry knows this, and it layers a second bias on top of it. Robert Cialdini identified authority bias, the automatic deference human beings extend to credentialed experts. A fund manager with a CFA designation, a fund house with 60 years of history, a financial advisor in a professional office. All of these trigger the same automatic response in the human brain. This person knows more than me, so the price they charge must reflect the value they deliver. The fee becomes evidence of quality. The higher the fee, the more the brain interprets it as proof of superior expertise. The industry's entire marketing architecture is designed to activate this bias before you read a single performance number. Let me tell you about Arjun Mehta. Arjun is 34 years old. He is a software engineer in Pune, earning 18 lakh rupees a year. In 2016, he started investing 15,000 rupees every month through a mutual fund distributor his uncle recommended. The distributor placed all of Arjun's money into regular plan actively managed funds that paid the distributor an annual trail commission of 0.85%. Arjun did not know a direct plan existed. The word regular sounded standard. It sounded like the established option. The word direct sounded like a shortcut, something for people who knew what they were doing. The industry designed that naming convention deliberately. Over 7 years, Arjun invested 12.6 lakh rupees. His portfolio value, in 2023, 21.4 lakh rupees. Had the identical monthly SIP gone into a direct plan, Nifty 50 index fund, his terminal value would have been 24.7 lakh rupees. The gap, 3.3 lakh rupees, produced entirely by the fee differential and the underperformance it generated. In January 2024, Arjun switched every SIP to direct plans through Zerodha Coin. The projected saving over his remaining 21 years to retirement, 14.2 lakh rupees in fees and recovered compounding. One administrative decision. No new money. No new risk. 14.2 lakh rupees. Now let me take you to Lagos. Chiamaka Okonkwo is 41 years old. She is an HR manager at a Lagos multinational, earning 850,000 naira per month. She has been enrolled in Nigeria's contributory pension scheme since 2010, 14 years of consistent contributions. In 14 years, Chiamaka has never reviewed her PFA's fee structure. Not because she is financially unsophisticated, because PENCOM's regulatory framework does not require PFAs to show cumulative fees as a line item on employee statements. Her RSA balance reads 12.4 million naira. What it does not show, an estimated 1.8 million naira already silently deducted in management and administrative fees across 14 years of contributions. The status quo bias operated perfectly here. There was nothing to object to because there was nothing to see. After Nigeria's SEC introduced a fee comparison tool for PFAs in 2023, Chiamaka requested a transfer to a lower-cost administrator. The projected improvement to her terminal retirement balance, 3.1 million naira. From reading one document she was never told existed. Here are the numbers you need to hold in your mind. 1. $243,000. The cost of a 1% fee differential on a $100,000 portfolio over 30 years. Vanguard, 2022. That fee is not a small percentage. It is a sum larger than most people's entire retirement savings. 2. 92.2% of U.S. active large cap managers underperform the S&P 500 over 15 years. Spiva, 2023. You paid for professional management. You had a 1 in 12 chance of getting what you paid for. 3. The average equity mutual fund investor earns 7.13% annually over 20 years. The S&P 500 returned 10.3%. Dalbar, 2023. That 3.17 percentage point gap compounds into a 63% difference in terminal wealth. 4. Switching from a regular to a direct plan on a 10 lakh rupee Indian investment over 20 years adds 9.3 lakh rupees to the terminal value. NEFI data, Value Research 2023. 1 administrative form. No new capital. 9.3 lakh rupees. 5. The global asset management industry generated $106 billion in fee revenue in 2023. McKinsey, 2024. That is what the industry earns for delivering, in aggregate, returns below what a passive index provides. The world's most profitable guaranteed underperformance product. Now let me give you 5 things that will permanently change how you see this industry. The cheapest funds do not merely save you fees, they statistically outperform expensive funds in every asset category over every time horizon above 3 years. Morningstar confirmed this in 2023. Fee level is the single most reliable predictor of future fund performance, more reliable than past returns, manager reputation, or star rating. The fund manager's incentive is not to maximize your return. It is to maximize assets under management, because fees are calculated on assets, not on performance. A manager who keeps you calm through underperformance earns the same fee as one who outperforms. That incentive has never been aligned with your outcome. The index fund is not passive in any negative sense. It is mathematically superior precisely because it eliminates the cost that guarantees active management's aggregate underperformance. Bogle did not create the index fund because he gave up finding great managers. He created it because he proved that identifying them in advance is statistically impossible. The direct plan in India, and its structural equivalent in every market, is not a product the industry will ever promote. It exists because regulators forced it to. Every investor who finds it independently takes money directly out of a distributor's future income stream. That is why it is never the first recommendation. And the most counterintuitive truth of all, the investor who does the least, who selects a broad index fund and never touches it, mathematically outperforms the investor who is most engaged, most research active, and most responsive to market conditions. In a fee-laden system, engagement is the enemy of returns. The industry profits most from the investor who pays the most attention. Here is what you do this week, starting today, with no additional capital required. Find your fund's total expense ratio right now. In the U.S., look up your fund ticker on Morningstar.com. The expense ratio is under Fund Details. In the UK, find your fund's key investor information document, the ongoing charges. Figure is mandatory disclosure. In India, go to AMFIC's website, search your fund name, and compare the TER for the regular plan versus the direct plan of the same fund. In Nigeria, request your PFA's full fee schedule in writing. PENCOM regulations require them to provide it within a defined time frame. Write down your current total annual cost. Find the direct or passive equivalent. Calculate the difference. Compound that difference over your investment horizon. That number is what you are deciding to keep or surrender today. If you save $500 or its equivalent every month, here is where to put it. In the U.S., Fidelity Zero Funds at 0% expense ratio, or Vanguard Total Market Index at 0.03%. Direct account, no advisor required. In the UK, Vanguard UK, Investor Platform, Global Index Tracker, 0.22%, all in including the platform fee. In India, Nifty 50 Index Fund via direct plan on Zerodha Coin or Grow. Total expense ratio between 0.1 and 0.2%. In Nigeria, for pension, use PENCOM's comparison tool to select the lowest fee PFA on the approved list. For additional investing, Bamboo or Risavest give direct access to U.S. index funds from a Nigerian account. In Southeast Asia, Fesmone in Singapore and Malaysia, Cole Financial in the Philippines for index fund access at low cost. If you save $2,000 or its equivalent every month, add a global diversification layer. In the U.S., combine VTI for total U.S. market exposure with VASIS for total international. In the UK, a FTSE All-World Index Fund through iShares or Vanguard covers both. In India, combine a domestic Nifty index fund with a U.S. or global index fund of funds for currency diversification. In every market, your target is a total portfolio expense ratio below 0.3% annually. If you retain an advisor, confirm in writing that they operate under a fiduciary standard and charge a flat fee, not a percentage of your assets. You came into this video believing that paying more for a managed fund bought you expertise and protection. Now you know that the fee is not deducted from a statement you receive. It is taken from your portfolio's gross value every single day before you ever see a number. Now you know the switch exists, the direct plan, the passive platform, the commission-free account, and that every market has a version of it that no one in the distribution chain will ever volunteer to mention. And now you know the SPIVA number: 92% in the US, 85% in India, 97% in Brazil. These are not aberrations from a system that mostly works. They are the system working exactly as designed, for the fund manager, not for you. The money you recover by acting on this is not hypothetical. It is sitting in your portfolio right now. It is being deducted daily, invisibly, with your signed consent, by an industry that built its entire architecture on the assumption that you would never do the arithmetic. The most expensive financial decision you will ever make is not a bad investment. It is paying someone else to make your investments worse. If this changed how you see your portfolio, subscribe, because every video on this channel is built to give you the information the financial industry has a direct financial incentive to make sure you never find.